All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's guest, we got back on Andy Panko. So stoked to have him back on. He's been on the show a few times. He's a certified financial planner, host of the popular retirement planning education podcast. Great guy, great perspective. He knows a lot of the nuance and details around a lot of these financial planning topics, and always has a good perspective to share. So happy to have him on for this one. We're going to kind of tackle the possibility of excluding $250,000 or up to $500,000 of gain on the sale of real estate, also known as the Section 121 exclusion. There's a lot to this, a lot of nuts and bolts, a lot of rules, a lot of exceptions, but we'll do our best to tackle it the best we can. As always, with any of this stuff, don't take everything you hear on this podcast or any podcast as financial, legal, or tax advice. Always kind of do your own research or check with your own professional on all this stuff. But Andy, thanks for joining us. Hope you're ready to jump into some Section 121 exclusion.
Oh, love it. Super nerdy, right up my alley. Very appreciative. Thank you for having me on again. It's always a great time to hang out and chat with you.
Awesome. So we're going to go over some examples, do some numbers. I know that's rough for the audio listeners of the podcast. I will share some PDF examples, and we'll try to keep it as easily digestible as possible as we go through this. So like I started off with, Section 121 is the formal name, right? A lot of these things, they get their names from the IRS tax code. And what it is essentially when you sell a primary residence, you can exclude from the gain for capital gains for single filers up to $250,000 and for married filing jointly up to $500,000. Okay, so that amount is not indexed for inflation. I don't know how long it's been that amount, Andy, but it's probably been that way for quite a while, right?
I was just thinking that as you were saying the dollar amounts, like since I've been paying attention, which is, I don't know, better part of 10 years, no, I don't think this has changed. So I'm curious now to know when this was put in place and hypothetically what the inflation adjusted amounts would be if they were to be indexed.
Yeah, this is a good question because I don't know, I should know this, but I don't know when this was put into effect, but I'm sure, like we saw over the last decade, home prices just shot up across the nation. So
yeah,
they got to be, exceeding the gain, this level of gain in a lot more situations now.
Oh, yeah, definitely. And especially certain states, certain markets, California comes to mind where home prices have just gone insanely high over the last 10, 20 years, especially for people who have owned their property, like retirees, right? Folks we commonly work with. They've owned their home for 30 years. Now they're planning on selling and moving to a different state. A lot of people have well over $1 million, if not $2 million of gain on their homes, right? And so even with this $250,000 or $500,000 exclusion, there's still potentially a lot of tax impact to selling your house here.
Yeah, and where I'm coming from here in Hawaii, we have very high, if not the highest, home prices, and there has been a lot of appreciation over the
Okay.
years. But a quick example before we jump in. So we got a married couple. They bought a home for $500,000 12 years ago, and then they sell it for $950,000. Okay, so that's $450,000 of gain. And because they're marrying filing jointly, they can potentially exclude $500,000. So that whole $450,000 of gain would be excluded. They won't have to pay capital gains tax. So that's the simplest form of what we're going to talk about here. Before we jump in, let's talk about what is a gain and what is basis, because that'll kind of launch us into the rest of the conversation. Do you want to kick us off with that, Andy?
Yeah, sure. So people may not think of their house, their primary residence, as an asset or as an investment in the traditional sense, but from the IRS's perspective, anytime you own something and you sell it for more than what you paid for it, that is a gain, and the IRS is going to want to tax that gain because it's now something you have that you didn't originally have, and they want to tax it. So by default, that's how to think about selling anything for more than what you paid for it. Now, primary residence has an exception, like you've already highlighted. There is an exception where you can exclude up to $250,000 or $500,000 of that gain. I guess just the IRS being nice because they don't, maybe it's an effort to try to provide some liquidity to the housing market, right? Because if people always had to pay tax on selling their house at a gain, that may make people reluctant to want to move, and it may sort of lock out, young buyers from finding homes to buy, whatever. So I don't know the original incentive or motivation behind it, but Point is, because it's a primary residence, it gets some special treatment with and a potential exclusion of some or all of the gain on the house. Now, there's some conditions. It's not that simple, right? You can't buy the house today, sell it next week, and exclude any gain you made in that short term, right? Is there some qualifying conditions people need to meet with this?
Yeah. Yeah.
I don't
So,
know if you want to get into that or that's coming down the road, but it's not quite as simple as buy it, sell it at a gain, and have it all excluded. There's some criteria you got to meet, right?
right. So your basis is going to be what you paid for the house. Plus, included in your basis would be capital improvements you make, right? Maybe you
Yeah.
add a new roof. So you bought the house for $500,000, you put a $20,000 roof on it. Well, now your basis is 520,000 instead of $500,000, right? So it's important for those listening who might have this in mind. You want to keep good records um, on everything that goes into, like your realtor commissions, your legal fees, your, any capital improvements, because that'll get added to the basis and thus reduce the gain on the sale down the road, right?
Correct. Great point. Yeah. So, like you said, improvements you make to the property include your basis, increase your basis, and therefore all else equal, reduce the amount of gain you'll eventually have when you go to sell it. But not all things that people may think of as improvements are actually improvements. I forget the specific wording, but it needs to, like, adding an addition is an improvement. Redoing your roof is an improvement. A complete remodel of a kitchen or bathroom is an improvement. Adding a deck is an improvement. Fixing a broken window that got cracked from a kid hitting a wiffle ball through it is not an improvement. It's just a repair. Repairs don't add to the basis, and there's no, tax benefit, generally speaking, of making repairs to your house. But improvements do, because they increase the basis and therefore reduce the total amount of gain. And you also mentioned expenses on closing. Definitely keep your closing statement. I forget the exact name. It's like the HUD statement, HUD. It's 2 pages. It looks like this big spreadsheet. It's got 2 columns, buyer and seller, and it lists out all of the cash comings and goings of the closing. Some of those expenses that you paid as the buyer increase your basis and therefore reduce your eventual gain, such as like fees you had to pay for title search. If you paid a realtor, if you paid a lawyer, those things do it. Not paying like partial amounts of property tax, for example, like or rebating property taxes already paid in advance by the seller. That's not a basis increasing expense. That's potentially a itemized deduction, right, for property taxes. Not to get too off on a tangent here, but point is, not every single thing that you consider a quote unquote closing cost is going to increase your basis, but some of it definitely will. So keep that closing statement, because you're going to potentially need it if you are selling the house at a gain later.
Sure. And then so now we figured out our gain. We had our basis, maybe we had some capital improvements, and we got our basis. We sell the house, and we figure out our gain. Well, we're going to get to the exemption, but just capital gains taxes for those. I mean, most listeners are probably very familiar. You're either going to pay the 0, 15, or 20%, depending on where the income falls. And that's based on, we're not going to go down the weeds here, but you get your ordinary income, your taxable income, and then your capital gains and dividends, qualified dividends, and all get stacked on top. That puts you in a bracket for the capital gains to determine whether it's in the 15 or 20% bracket there.
Right.
Yeah. And then the
Plus
other thing,
state, depending on your state, right? There's your states may have their own. Most states don't tax capital gains, long-term gains any differently than anything else. It just taxes ordinary income. A lot of states, maybe getting ahead a little bit, but a lot of states follow federal process in exempting, up to certain amounts of the gain on the sale of a primary residence.
yeah, totally. And Hawaii here, we have it's like a flat capital gains tax of 7.25%. And
Okay.
it does follow suit with the, the whatever is excluded via the Section 121 for federal purposes, that is also excluded for the state purposes, like you're saying there. And then lastly, this can kind of sneak up on people, and we won't go down into how this is all calculated, but there is net investment income tax, NIT, the 3.8%, that can also be kind of tacked on to some or all of the gain there.
Yeah, definitely. And any gain that's not excluded under this 250 or $500,000 that does hit your tax return is going to be subject to the, like you said, long-term capital gains. I'm just speaking federally now,
Mhm.
of either 0, 15, or 20%. And then if your total gross income, inclusive of the non-excludable gain, is over, what is it, 250 for married people, 200 for single, then the additional 3.8% net investment income tax does apply. Sale of, taxable gain of the sale of a primary residence isn't excluded from the 3.8% net investment income tax. Furthermore, because this non-excludable gain does get included in your gross income, it could impact other things for people where other provisions of the tax code that are driven off of gross income or modified adjusted gross income, like for people on Medicare, the IRMAA surcharges, the income-based premium surcharges. So you sell a house one year and it spikes your income $500,000 from the gain beyond the exclusion. That's going to put these people into IRMAA territory for one year. Now, depending on the circumstances around why they sold the house, there might be a qualifying IRMAA waiver event associated with it, like death of a spouse or something. But otherwise, you just sell your house because you're moving. That's going to hit your income for a year. That's going to potentially cause some IRMAA.
Yeah, and I think a lot of people, they probably get caught off guard if they have a huge gain on the sale and then they're going to see, okay, I pay 15 or 20% capital gains federally. Oh, I have income from working, so now I'm in the NIIT, so I'm going to tack on 3.8%. I live in Hawaii, so they're going to give 7.25%. And then all of a sudden, you're up to, potentially 30% or more that you're paying in on the gain, those capital gains.
Yeah, you don't feel like you're walking away with as much money anymore. When you carve out the taxes, you have to pay on it, right?
Right, right.
Yeah.
Okay, cool. So that was a good kind of background on, basis and capital gains there. So let's go to this exclusion, the ownership and use test. So how do you qualify for this 250 or $500,000? Is there's an ownership test and a use test, both of which follow the 2 out of 5 year rule, right? So you need to own it for 2 out of 5 years, and you need to use it as a primary residence, your home, for 2 out of the last 5 years. There's a lot of exceptions, and we probably won't touch on them all. But for instance, one spouse can own it, and as long as both spouses use it for that 2 out of 5 years, then it qualifies. And it doesn't have to be consecutive. I don't know in what situation that would happen, but you could live there, move, and come back, and I guess it still applies. Um, and you can't use this more than once every 2 years, which is pretty obvious, right? I mean, I don't know how frequently you would try to use it, but anything you want to add on the ownership and use test? I know there's a lot of exceptions and a lot of nuances, and we'll kind of get into later on the qualifying reasons why you still can qualify if you have like moving for, health or whatever job stuff.
Yeah, you hit it well. It's not consecutive. And one thing to clarify, it's 2 out of 5 years leading up to the date of the sale, up to the date of closing. It's not like leading up to the date of the end of that tax year. So if you sell your house, whatever, pick a date, June 15th, 2026, that's your closing date when you actually sell it. You need to have lived in it and owned it at least 2 out of 5 years leading up to June 15th, 2026. So that would mean that would start whatever, June 15th, 2021 would be the start of that 5 year clock. And like you said, it doesn't need to be continuous. I don't know how or why you do this, but you can live in it for a month, move out for 2 weeks, live in it for 3 months, whatever. As long as you can cobble together at least 730 days collectively of ownership and use as primary residence within that 5 year window, you're good. You qualify for the exclusion. Like you said, with married people, in the case of a married couple, only one actually has to own the place. So like be on the title, right? The other spouse doesn't have to. So as long as one spouse is on the title, at least those 730 days, they meet the ownership test. But for use test, both spouses do have to live there. They both have to, together or independently, meet the 730 days of use as primary residence during those 5 years.
Sure. And there's a lot of exceptions. I'm not going to run through them, but like for if there's a divorce and all these other things of how to look at it. I will say for those who have two houses, and you can see this sometimes where people, maybe it's for state tax purposes or they're snowbirds and whatever else is, there's always going to be one home that is your what is the term? The domicile, right?
Yeah.
Your primary place. And usually you have your driver's license where you get your mail. There's always going to be one, so you can't live in one place, have a house somewhere else, and just arbitrarily say, well, no, this is my primary residence. I'm going to use the exclusion. You'll have a domicile, right?
Yeah, you do. Now, you can use this to your benefit if you have multiple properties, but you do need to be careful. Like you said, you can't use this exclusion more than once every 2 consecutive years. So, like, for example, you've owned your primary residence for 30 years, you've owned a vacation home next state over for the last 20 years. They're both highly appreciated. You can, not in theory, but you can like sell your primary residence, right? You can qualify the exclusion there. You no longer have that house. You can, if life permits, you can move into what was your second property or your vacation property. You can move into that and legitimately make that your permanent residence, not just on paper, but actually live there, right? Have your voter registration, your license, reestablish a place of worship if you're in one, spend most of your time there, et cetera, et cetera. That then becomes your primary residence. You live there for 2 years. You can then sell that place 2 years later and exclude, get the gain exclusion again on that place.
Yeah, and we're gonna jump into a couple examples and talk about the partial exclusion versus prorated gain when you have mixed use rental property and whatnot. But before we do, I think we could touch on step up in basis. And the step up in basis, so if you bought the house for your basis, like we talked about before, 500,000, you add some improvements, it's 550,000. Now it gets a little bit complicated. We don't have to get too deep in the weeds as far as separate property states versus community property states. But essentially, if both spouses die and the house goes to the children, let's say the house is going to be stepped up to the fair market value at the date of death. That's the new basis that the children will inherit. Now, when we're talking about separate property and community property states, in community property states, if you have a couple and one spouse passes away, the property gets a full step up in basis to the fair market value at the date of that deceased spouse's death, even for the surviving spouse. Now, separate property states, one spouse passes away, only their share. So you got to think of it as they own 50% and the other spouse owns 50%. So their share of the property will get that step up in basis, but you're not going to get the full step up in basis in community property. I know it's tough to talk through and it gets kind of complicated, but do you have anything you'd like to add there?
No, that's right. I guess that could come into context, like if a couple, let's assume they're in retirement, they're later in stages, later in life, and they're considering potentially selling a highly appreciated house. Let's say there's $1 million+ of gain on it. To move, if they do that, they're going to pay tax on at least some of the gain because that gain will exceed the amount of exclusion they can use. Maybe, a possible tax and wealth transfer and legacy planning opportunity here is don't sell the house during life, die still owning the house. So to your point, it'll get a step up in basis, assuming you're living in the house with the kids. It'll get a step up in basis where whatever unrealized gain the original couple had, that all disappears in the hands of the heirs. They then can turn around and sell it the next day. There's effectively going to be no gain, right? Depending how much time passes from when they inherit it. And that's one thing to consider. But generally speaking, I think life more so dictates when and why you sell a house, less so kind of longer term legacy planning stuff.
Yeah, and that's a great point to kind of hammer home because we're going to get into a lot of things to consider, but in the end, like you said, a lot of times this is just it's things to know. It shouldn't really dictate what you're doing with your life or what life circumstances
Yeah.
get thrown at you. It's just understanding of the taxation, not letting this drive your decision making per se. Um, yeah, and oftentimes, Andy, do you ever get the question? Because I do. Should I add my children to the title of the house? Should I gift it to the children? Because I get that not a lot, but every once in a while, and I think they're missing out on that step up in basis there.
I do, not just with real estate, but even financial accounts, right? Day-to-day bank accounts, checking accounts, brokerage accounts. Clients often, people often ask this with the best of intentions, with thinking it will help facilitate a smooth estate and property and account transition process upon the passing of the person. But there could be tax implications to that, and changing the step up in basis favorability around that.
Yeah. Okay, so now we'll
Definitely.
get into the meat and potatoes here. We're going to talk partial exclusion. And what we're talking about with partial exclusion, and we don't want to confuse this with non-qualified use and rental. We're talking partial exclusion, meaning you didn't get the 2 years, the full 2 out of 5 years. And common reasons you can still qualify for a partial exclusion is a work-related move, a health-related move, certain military and government reassignments, and I'm sure there's a few more out there, but those are the big ones. So let's look at work-related move and health-related move. Work-related move, a taxpayer lives in a home for 1 year, then takes a new job where the new workplace is at least 50 miles farther from the sold home than the former workplace. Okay, so they got a new job more than 50 miles away. Health related, a taxpayer moves after 1 year to be closer to a medical care for themselves or a qualifying family member. Okay, so yeah, it's important to kind of read through these to make sure, like the 50 miles, it seems kind of arbitrary, but you can't get a new job, you know, 20 miles,
5 miles away. Yeah,
yeah, 20
exactly.
miles, 20 minutes away and think, well, yeah, I qualify for this. Okay, so I'm going to run through an example. Bear with us, audio listeners. Andy, chime in whenever you want here. So we got Jack and Jill. They buy a home for $600,000. After living in the home for 12 months, 1 year, Jill receives a job offer in another city. Okay, it's more than 50 miles away from their current home. Okay, so they decide to sell the home and move. They sell the home for 720,000. The original purchase price was 600,000. So their gain was 120,000. Now, they only lived there for 1 year out of the 2 out of 5, right? They still qualify because her new job was more than 50 miles away. But the required time for the full exclusion was 2 years. They only lived there for 1 year. So therefore, they can use 50% of their total exclusion. So as a married couple, it was 500,000 as the exclusion. They only lived there for 1 year instead of 2 years, so they get 50% of that, which is $250,000 that they can use as their exclusion amount when they move. And since the gain was only $120,000, they exclude the whole thing. So even though they didn't have the 2 out of 5 years, because it was a qualifying reason, they moved for work more than 50 miles away. They just have to figure out what percentage of the exclusion they can use, right? So let's say they lived there for 6 months. Then they would get 25% of the $500,000 married because they're married filing jointly. They would get 25% of that they can use to exclude for the capital gains and the gain on the sale. What are your thoughts there, Andy?
Yeah, that all jives. That's all right. One thing I want to point out to people, and I know you spelled this out. You said this accurately, but just to drive this home to people, it's not simply that the new job has to be at least 50 miles away from the new house, or from your old house. I'm sorry. It's the difference in mileage to work for the new job needs to be more than 50 miles than the current one. So here's what I'm trying to say. So let's say currently you live in a house where your work is 30 miles away, and you lived in this house for a year. You bought it a year ago, you lived in it for a year. It's 30 miles away. You get a new job where that job is 55 miles away from the house. That wouldn't qualify. That's more than 50 miles from your house, but it's not more than 50 miles greater from where the current job is. So in this example, if your job is 30 miles, I think I said 30 miles away from the house, the new job would need to be at least 80, I guess 81 miles technically, at least 81 miles away from where the old house is to qualify for this partial exclusion.
Yeah, great point. That's why I love having you on, Andy, because you come.
Yeah, the devil's in details. I mean, I know you said it correctly, but I don't think most people would have picked up on the nuance of
Right.
what that actually meant. So I just want to throw that in there. Yeah.
Sure. Okay, so that's the partial exclusion. So now let's look at rental properties. Here in Hawaii, rental properties are very prevalent, whether that's the Airbnb style or the long-term rentals. So let's start with we'll do two scenarios: former primary residence turned into a rental property, and then a rental property turned into a primary residence. The thing to consider here is there's something called non-qualified use. And that's important because the years that the property is a rental property is considered non-qualified use. So the portion of gain you have to calculate, let's say it was non-qualified for 75% of the time and its primary residence for 25% of the time. 75% of that gain, whatever that gain was, needs to be pulled out of the equation when it comes to applying the exclusion, right? That's the basics of non-qualified use, meaning rental property, right? For our
Yeah.
purposes here. The other thing to consider is depreciation when it comes to rental property. Andy, you want to touch on depreciation?
I would love to. Yeah. So depreciation when you own a rental property, whether it's your own house you turn it into a rental or you buy a place from the gates to be a rent, right out of the gates to be a rental. It's now in effect a business asset. You may not view it that way, but it's a business asset. And business assets are able to be depreciated, meaning they have an assumed useful life in the eyes of the IRS. And that assumed useful life, the value of the property, in effect, like kind of, I don't know, depletes a little bit over the course of the depreciable life. In the case of residential real estate, it's 27 and a half years is the assumed depreciable life of the value of that business property. So every year along the way that you own this rental, you can deduct against your rental income this calculated depreciation expense. So it feels awesome in the years you're doing this because it's not a cash expense. Like when you pay for utilities or you pay for like a lawyer for the property or whatever, you're actually like outlaying cash to have this expense. And then you get to deduct that expense against your rental income. Well, depreciation is a non-cash expense. It doesn't cost you anything out of pocket to get this depreciation, but you get to deduct it from your income nonetheless. It's like, hey, awesome. But whenever you go to eventually sell this place, all that depreciation expense that you took along the way or could have taken, and hold that thought, you then have to come back and include that in your income in the year of the sale. Now, one wrinkle, it's capped out at, it's taxed as ordinary income, but at no more than 25% federally. States can be different, but federally there's a 25% cap on how much tax you pay on depreciation that you recapture. That wrinkle I said of you have to add back in the depreciation you expensed or could have expensed means even if you or your tax return preparer didn't know that you could and should deduct depreciation along the years on this rental, doesn't matter. You still have to add back to income when you sell it any depreciation you did or could have deducted along the way. So just keep that in mind. And like you said, the depreciation you have to recapture and include back in your income is not eligible to be excluded at all. The gains, the exclusions we're talking about at 250 or 500 only apply to the gain that's not depreciation recapture.
Yeah, I think depreciation, I think oftentimes people think it's a great deal until it comes back to kind of bite
Yeah.
them in the end. Yeah.
No, yeah, that's one of my pet peeves is especially like social media influencer will say how great real estate is as an investor and as an investment because you get these big expense deductions for depreciation. It's like you do throughout the years, but if you ever go to sell it, it all comes back to you.
Right.
Now, granted, again, it's capped out at 25% tax bracket federally. There's ways to kind of keep deferring it, not to get too in the weeds, but if you die owning the place, you come back to step up in basis. Whoever you leave the house to, all the gains, unrealized gains disappear. All of the depreciation that wasn't yet recaptured disappears, and the heir inherits it as if they bought it at the value of the property on the day of your death. There's some other things like exchanges you can do, but let's not get into that. So yeah, it's not to say rentals are a bad investment necessarily because of it, but it's not quite as good as people may make it seem on the surface with the expenses and depreciation and things you can quote unquote write off relating rental properties.
Sure. Okay, so let's talk about a primary residence that is then turned into a rental property. And the main point I want to hammer home here is I didn't mention this earlier, but IRS publication 523 is where all of these details are around what we're talking about. And in there, it says that non-qualified use, meaning the time that the property is a rental property, does not include any portion of the 5-year period ending on the date of sale that occurs after the last date you use the property as your main home. What that means is that if I lived in a house for 20 years and I decide I'm moving or I'm going to go live in Colorado, right, for a couple of years and I'm going to rent out the house, as long as I live there 2 out of the last 5 years, meaning I can rent it for 3 years after I've moved out, that 3-year period is not counted as non-qualified use, and we don't need to factor that into our equation for figuring out what part of the gain will be applied to the exemption, right?
Yes, exactly. You still have to recapture and pay income tax on all the depreciation expense you may have had or could have had during those, whatever, 2 or 3 years of rental.
Mhm.
But yeah, the order in which you do this matters. If you own it and live in it, primary residence, and then rent it, you don't have to do this exclusion that you talked about. But the opposite is like the first example you gave. You first rented it out, then you decide to move into it as primary residence. Then you do have to do this proration between qualified and non-qualified use relative to the gain. One other comment, I mean, you said this, I just want to drive it home. When there is non-qualified use and you have to prorate things, you're not prorating the amount of exclusion that you have. The 250 and 500 is still 250 and 500. You're just prorating the amount of gain that's eligible to potentially be excluded under the 250 or 500. So,
Yeah, no, great point. And let's go through an example here. Bear with us, audio listeners, and I'll put a link to a PDF where you can look this up as well. So let's run through that scenario. I bought an investment property that we rented out, right? And then it turns into a primary residence. So in our example, Jack and Jill buy a Colorado mountain home for $400,000. For the first 6 years, they use the property as a vacation rental. Okay. Later, they decide to move into the home full time as their primary residence for 2 years. Okay. So they had it as a vacation rental home for 6 years, and then they decide to live in it for 2 years as their primary residence after that. Right. So they own the home for a total of 8 years. Okay. And they sell it for $700,000, meaning their gain in total. We're kind of leaving out, we'll leave out the expenses, depreciation, and all that kind of stuff for this example.
yep.
But their gain in total is $300,000, okay, over the 8 years. Now, because they rented it out first and then moved in for 2 years, those 6 years of being a rental property need to be accounted for, and that portion of the gain needs to be excluded. So 6 out of 8 years is 75%. Okay. So their total gain was $300,000. 75% of that gain is attributable to the non-qualified use, the 6 years it was a rental property. That equals $225,000. Okay. So what's going to happen is that $225,000 you're going to pay the capital gains tax on. That gets put into a separate bucket. You can't apply this exclusion to that amount of gain. Okay, so the potential Section 121 exclusion would be remaining gain to 25% that was a primary residence, which is $75,000. So now you can use your exemption, and because they lived there 2 out of the last 5 years, they still can use the full $500,000. That doesn't get adjusted because 2 out of 5 years, the ownership and use test, they get that. The problem is that $500,000 of exclusion only will apply to the time it was a primary residence, meaning only to that $75,000. So they don't have to pay the capital gains on that $75,000. However, that period of time, the 75%, 6 out of 8 years, that it was non-qualified use, that $225,000 gain attributable to that will be taxed as capital gains. Andy, did I do a good enough job clearly running through that example?
Definitely, yeah. And the handout will definitely make this come to life for people because it's laid out very, very clearly. I just want to say that my assumption is the reason why you have to prorate your excludable gain if you rent it first and then live in it versus the other way around is because the IRS knows this trick, right? Like if
Mm,
you bought a rental property 10 years, in your example, 8 years ago, you bought it with the intentions of renting it. You bought it, in effect to be a business venture, a business income producing property. And then it appreciates a lot in value. Like, oh man, that's a lot of gain. I don't want to pay that. Hey, you know what? Let me just live in it for 2 years, make it go away. IRS is like, no, no, no. Like we realize people have been doing that. So they changed the rule. You used to be able to do it, I think, decades ago.
mm.
I looked into this at one point, but the IRS, maybe it's 20 years back, maybe more at this point,
Yeah, I think it's
put this
2000,
change.
2008. I could be wrong, but I think it's
Was it? Okay.
2000. Yeah.
Like, no, no, no. You can't simply live in it for 2 years and then sell it to make all the gain go away. We're going to make you prorate how much of it was, like you said, qualified use as actual primary homeownership, primary residence, non-qualified use, meaning the business use of having it as a rental. So that's why you have to prorate it one way, but not the other. Again, if you live in it first, then rent it for 2 years, you do not have to prorate the amount of gain that's eligible to be excluded.
Yeah.
So,
Yeah, so it's interesting, and there are a lot of planning opportunities around this. Like we kind of mentioned before, a lot of times this is just dictated by life circumstances and life events, not so much the tax implications of things, but it is something to consider. I don't pretend to be an expert on 1031 exchanges. I'm very familiar with them, but I'm not an expert on them. There are ways to combine the Section 121 and the 1031 exchanges. I don't think we'll get into it here. Andy, do you want to just touch on any of that, or should we just keep it
I don't
moving?
know. Just I guess one thing I know I'm probably I know enough to be dangerous, just like you with 1031 exchanges. One thing, so 1031 exchange at a super high level is just when you have a rental property that or income producing property you're looking to sell, and you have gains and or depreciation to recapture. If you were to sell it, you're gonna you have tax on the gains and the depreciation recapture. 1031 exchange is simply a mechanism by which you can, in effect, you sell that property and transfer or roll the proceeds into a new comparable rental or income producing property. You don't get rid of the gains or depreciation recapture. You're just like punting it. You're just rolling it into the new one. So if you ever sell that new one, then you have to recognize it. The reason why I'm bringing this up is just because if the property you're living in is your primary residence that you eventually sell and want to exclude the gain, I believe if you acquired this property through a 1031 exchange in the first place, that may completely nullify the ability to take any 121. I could be wrong, but I think that's what I read right at the top of publication 523.
Okay. Yeah.
Just it's something to look into, right? For people who
Right,
are
right, right.
rental investors and do actually do or are considering doing 1031 exchanges, be very clear you understand the rules around that and how that interplays with this gain exclusion before you make any decisions.
Yeah. Definitely. That's a pretty complicated move. I would say the majority of people probably aren't going to come across. And
Yeah.
if you are, talk to your CPA or somebody who can help guide you through that. Because those 1031 exchanges, there's a lot of nuance and rules just around doing it, regardless of the
Right.
exclusion amount. So you want to make sure because it can blow up in your face if done incorrectly. So
Yeah, don't step into that lightly. A
yeah,
1031 exchange. Like I said, I know enough to be dangerous. I know there's lots of rules and process you have to follow to qualify for this continued deferral of gains and depreciation.
yeah. Okay, so let's talk about some planning scenarios that we might see. So a common one is a lot of people maybe they retire and they want to spend their retirement in Florida. They raised their kids, they lived in wherever it might be, maybe New Jersey, or maybe they're in Hawaii and they say, well, it's just too darn expensive. I'm going to move to Nevada, right? I'm going to retire to New Mexico, Albuquerque. And they might start to map out, okay, well, let me do some numbers. Okay, I had this house, for this long. I should be able to downsize and I'll walk away with this amount of gain. Um, but then they can get bitten by uh, the IRMAA or exceeding these home exclusions. Now, that shouldn't dictate, what you're going to do necessarily, but it can come as a surprise when they say, "Oh, I thought I bought the house for this and I sold it for this. I thought I'd walk away with all that money and now I'd be set up to retire." But then you realize, like we talked about earlier, you could pay up to 30% once you start factoring in NIIT and state tax and all that. Anything you want to talk about there? Because I think that's a fairly common scenario of retirees wanting to move somewhere else for retirement, like a Florida move or wherever it might be.
Yeah, the scenario definitely is common. The amount of times in my anecdotal experience where the sale of the house excludes the relevant 121 exclusion, or I'm sorry, exceeds the relevant 121 exclusion isn't that common. California definitely, some other states maybe, some other, particularly Hawaii, I assume as well. Some other hot markets throughout certain parts of the country. But generally speaking, like for a married couple, for example, $500,000 a gain, that's a lot, especially when you factor in those other things in basis we talked about, right? Like, yeah, maybe you bought the house in 1987 for $30,000, and maybe now the sales price is $700,000, but you did $100,000 kitchen renovation along the way, right? You did a $20,000 fence, you did a $20,000 deck. You start adding these things together, realtor commissions come off the top as well. So right off the bat, for example, you sell your house for $700,000. Let's assume you're paying 5 to 6% realtor commissions all in. That's 35 to 42 grand. That also reduces the amount of gain that you have to run through these things. So point is, for a lot of people, especially married people, $500,000 of gain exclusion still gets them pretty far, such that they don't have to worry about this. But if you have $1 million plus of gain, the tax bite is going to be large, and just be aware of that going into it. Plan your cash flow accordingly. Pay taxes timely as well. We can do a whole episode about paying estimated taxes and when you have to pay it and underpayment interest. But if you sell your house in the first quarter of the year, and let's assume you have a $600,000 net long-term gain even after your exclusion, that's a lot of tax. You're going to have to pay estimated taxes on that 600 grand in the first quarter. Don't wait till the end of the year, because you will have underpayment interest on that.
Yeah, and I think it's a good reminder, like you touched on, with the increasing the basis and the new roof. You can't expense these things to your primary residence. So you might do this. Maybe you lived in the home for 30 years, and in your second year of owning the home, you paid to have all these, capital improvements, new roof, new addition, and you're going to sell the home 30 years later. Your accountant or tax software or enrolled agent isn't going to know that that's going to be added to the basis. And
Right.
I'm sure throughout history, there's been a ton of capital improvements that were just lost or forgotten or not. I mean, it just wasn't, top of mind to bring up to add to the basis.
Yeah, that's true. You lived in a house a long time. More times than not, people aren't going to have the receipts or the records of that whatever $25,000 basement renovation they did in 1992. So this is a bigger issue, a bigger topic. But anytime you're claiming an expense or a deduction on a tax return for anything, you need proper documentation, because if and when the IRS comes asking, say, prove to me you actually did this basement renovation. If you're not able to produce whatever, the final receipt to itemize the receipt showing what all went into it from the contractor or whatever, the IRS will almost certainly disallow that claim, that deduction or that increase to your basis in the case of this example. So keep good records. Now, obviously, you can't go back to 1992 and go, the contractor's probably long gone at that point or passed on. Good luck trying to get some sort of defensible documentation of what that was from 30 plus years ago. But just know going forward, any improvements that you do, keep the records, keep the receipts, keep the invoices, keep the bills, because it might potentially matter down the road when you have to substantiate this.
Yeah, and the other scenario I kind of want to touch on is, for a lot of us out there, our home is like our biggest source of sort of net worth, right? It can have a lot of equity, and it can be used outside of retirement accounts and other cash to kind of fill the gap with long-term care, right? We can say, well, we have all this equity. When that time comes, I'll sell it, and once one spouse passes away, maybe I sell it and I need to move into a facility or whatever it is. I think that's fairly common that maybe that decision falls on the children sometimes when maybe the parents are starting to kind of lose it mentally and physically where they got to sell the home. Not a super common, but a niche situation, especially here in Hawaii. I mean, if you bought the house in the 70s and you're selling it now, I mean, you have, I guarantee, more than $1 million of gain. Um, but maybe you do some planning around selling it in a time where you still can capture if one of your parents passes away and the other one is still there, but you know they're going to need help in the future. Maybe you decide to sell it sooner rather than later, so you can capture the full $500,000 versus the $250,000. Again, it shouldn't drive the decision. We're talking about, somebody's quality of life and living, but I guess there is a situation where, that could come into play.
Yeah. And with spouses, when one passes, you have up until, I think it's 2 years from date of death to still take the full $500,000 married exclusion. Not saying that should force you to feel like you have to sell a house, right? But point is, like, you don't lose the $500,000. So let me just step back a little bit. When there's a married couple and someone dies during the year, for the remainder of that year and for that tax filing year, the survivor will still file as a married tax return. Married tax return. They'll still get the married tax brackets. They'll still get the marriage standard deductions, et cetera. But the next year, assuming they don't remarry, they will have to file as a single person and the single tax brackets and whatever. Well, this 121 exclusion, it's a little different. It's a little more beneficial and favorable because you do still get to use the $500,000 married exclusion for up to 2 years after the date of death. Even though you'll be filing a single, you get the married version of the exclusion. So I did actually have this in practice with a client, coincidentally in California. So like size mattered. They had a lot of gain here. And part of some life changes and whatever after the passing of the first spouse did end up selling the house roughly a year later and still got the benefit from the $500,000 exclusion.
Yeah. Yeah, there's just a lot of nuance to this, and I don't expect anybody to listening. I mean, props to you if you followed us all the way through and you got all this memorized. Hopefully it's just food for thought, and we pointed out a few things where when that time comes, you can kind of look into it, look into the exceptions, look into what qualifies, and look into other things to consider, like how it affects your Medicare, IRMAA, and NIIT and whatnot. But yeah, there's a lot to it, a lot of details. Andy, I really appreciate you coming on. Hopefully we did the topic justice, and hopefully had a little fun along the way.
I did. Thank you as always. I enjoyed being here, and this was a great topic. I'm sure a lot of people will get a lot from it.
Right on. Appreciate it, Andy.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Cutitta, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.